Good day, everyone. These are the 7 big fat lies that your financial advisor tells you about Bitcoin. So forward this to your friends and family so they can hear the truth about Bitcoin once and for all. Financial advisors usually end a Bitcoin conversation with a single word, and that word is volatility. And then they hope that the client drops the topic. Volatility measures the speed of price changes, not the probability of long-term loss. Every single 4-year window since 2009 has finished positive in Bitcoin with a median gain above 500%. Short-term price movement has never erased that record. The standard deviation on monthly returns exceeds mature equities, yet the compensation in compounded return is a lot larger. The back test show that adding just 2% Bitcoin to a 60-40 portfolio lifts the 10-year Sharpe ratio from 0.62 to 0.79 while trimming the worst drawdown by about 2 percentage points. Portfolio theory rewards assets whose extra return outweighs their additional variance. Bitcoin fits that rule precisely. Now, the investors who dislike the Sharpe price moves, they rely on dollar cost averaging. Did you know that automating daily or weekly buys cuts your entry price variability by roughly 80% over the course of a year, according to Swan data? Volatility is literally only a statistic. With discipline, a fixed rule set, and a 4-year time horizon, that statistic becomes an advantage. Economists still like to bicker about intrinsic value, a phrase that only survives because it sounds sophisticated, but in practice, it is about as empty as a Fed balance sheet on audit day. The first principle, value is never intrinsic, it is relational. A thing is worth what humans coordinate to exchange for it. And if you doubt that, look at the auction price of a used sock from your favorite athlete. Bitcoin satisfies every objective test of economic usefulness better than any legacy assets that critics label intrinsic. Just look at proof of work. Each coin embodies verifiable energy expenditure. You cannot counterfeit jewels. When the network hash rate rises, attack costs rise in lockstep, tying security directly to physics. There's a hard cap. The 21 million Bitcoin is coded, it's auditable, and it's immune to committee votes. And no other asset offers a supply schedule that every participant can verify in about 10 minutes with a Raspberry Pi. A Bitcoin transaction clears worldwide final in about every 10 minutes and does not reverse because a clearinghouse clerk ran out of coffee. Dollar wires fail that basic test every single weekend. And it has the deepest liquidity because Bitcoin trades across every major exchange 24 hours a day with billions of dollars in daily volume, very tight spreads, and robust derivatives markets. That liquidity of Bitcoin is earned and not guaranteed by some government decree. We have the gold advocates. They like to brag about the 5,000 years of history, and then they admit that nobody knows its actual float. The equity investors, they claim dividends signal value, and then they watch boards suspend payouts in a single phone call. The fiat partisans, they trust central banks that have missed every inflation target for a decade. Bitcoin requires none of that faith at all. It offers auditable scarcity, physics-backed security, permissionless transfer, and measurable market depth. If those traits are not intrinsic, the term has no meaning that is worth preserving. The critics can cling to centuries-old vocabulary. The market has already upgraded the dictionary. The financial advisors out there will chant that a government ban is right around the corner, but they ignore 4 stubborn facts. First is a legal precedent. The U.S. federal courts have ruled that software code is protected speech. That decision places Bitcoin scripts in the same constitutional bucket as books and journalism. Confiscation faces an even higher bar because Bitcoin balances are legally recognized property. Any wholesale ban would need to survive very strict scrutiny in federal appellate courts. Good luck convincing a judge to criminalize publishing open source math. Second, that would be ignoring all of the institutional adoption. Fortune 500 treasuries, public pensions, BlackRock-sponsored ETFs, they all hold Bitcoin today. Banning Bitcoin would instantly haircut millions of retired retirement accounts, and several $trillion in listed equities. Senators who enjoy re-election do not detonate the S&P 500 on live television. Third is global recognition. El Salvador and the Central African Republic already treat Bitcoin as legal tender. Germany taxes long-term holdings at 0%. Japan classifies it as legal property with very clear accounting rules. When multiple sovereigns accept an asset outright, unilateral prohibition by others morphs into a self-inflicted trade embargo. This is just unrealistic, folks. The cat is out of the bag on Bitcoin. And fourth is just the network resilience, because China attempted a mining exodus in 2021. Within 10 months, global hash rate hit a new record. Hash power now spans every populated continent. Shutting it down means coordinating simultaneous action across hundreds of regulatory regimes that cannot even agree on tax treaties. So yeah, a government can harass exchanges, it can complicate fiat on-ramps, it can tweet stern warnings, but an outright ban clashes with constitutional law, market incentives, and international diplomacy, as well as just basic game theory. The claim does not survive first contact with reality. And then you hear this, that the opportunity window has closed, but the data says otherwise. Global adoption of Bitcoin remains under 5%, so more than 7 billion people who have zero exposure to Bitcoin yet. History shows that network effects accelerate when participation crosses 10%. And with Bitcoin's market cap about 1/10 of gold, the convergence with that single benchmark implies a tenfold price increase without assuming any other growth driver. Every 210,000 blocks, the protocol cuts the new issuance in half. After the next reduction, the annual supply expansion falls below 1%. Lower than world population growth and dramatically lower than fiat money supply growth. And remember, dollar cost averaging pretty much neutralizes a timing error. Fun fact for you, a monthly $100 purchase started at the December 2017 peak, turned $15,600 into more than $60,000 today, despite 2 drawdowns that were greater than 70%. The expected return of Bitcoin remains strongly positive because the demand can rise orders of magnitude while the supply growth trends towards zero. This is basic supply and demand economics. Now, in my humble opinion, not financial advice, but the rational strategy is obviously to size a position responsibly, automate your accumulation, and evaluate performance after at least one halving cycle. Anyone claiming that the gains are gone is ignoring basic arithmetic and demographic reality. And this is my favorite, lie number 5, that only criminals use Bitcoin. Dismissing Bitcoin as a crime coin sounds dramatic until the numbers just enter the room. Chainalysis reviews every on-chain transaction each year. Its 2025 report attributes under 0.4% of Bitcoin volume to illicit activity. That is a rounding error next to the trillions of laundered dollars flowing through cash, correspondent banking, and opaque tax havens. The FBI itself still classifies physical dollars as the primary medium for narcotics, human trafficking, and terrorism finance. 99% of global crime uses government currencies because suitcases do not leave audit trails. And Bitcoin provides literally the opposite environment. Every transaction is timestamped, it's immutable and searchable by anyone with an internet connection. Agencies ranging from Europol to the IRS, they can exploit that ledger to trace ransom payments, shut down darknet markets, and recover stolen funds. We have seen that happen this year. Criminals migrate to privacy coins or prepaid gift cards precisely because Bitcoin is too transparent. And institutional behavior just confirms the point that I'm making. Fortune 500 treasuries, SEC-regulated ETFs, and sovereign wealth funds, they hold Bitcoin within strict compliance programs. None of those boards would authorize exposure if material legal risk remained. So this ridiculous accusation totally collapses once statistics, enforcement outcomes, and corporate actions are all examined. The vast majority of criminal finance remains a cash story, while Bitcoin's ledger becomes a forensic accountant's best friend. Number 6, critics insist that holding your own Bitcoin demands elite programming skills. Reality just disagrees with that. If you didn't know, it is very simple hardware. The hardware wallets that are out there nowadays, they ship as 2-button USB devices. The setup requires about 5 minutes, a pin, and 12 or 24 words written on paper. No commands line, no soldering iron required. And then multi-sig security totally removes the single point of failure risk. Smartphone apps and desktop clients guide users through every single step. The process feels like adding a secondary email factor, except the second key might live on a separate device with a trusted relative. Tens of thousands of retail holders already run multisig without incident. And then there's endless concierge and community support. They fill any remaining knowledge gap. Independent guides are out there. There's YouTube videos. There's open source documentation. There's free helplines that will walk newcomers through seed backup, firmware checks, and test sends. If someone can follow online banking instructions from 2005, they can follow these. And then the usability just continues to improve because the modern wallet interfaces, they resemble a very simplified mobile banking app. There's big buttons for receive, send, and verify address. There's very clear fee sliders and automatic change address handling. Self-custody no longer belongs to hackers with water-cooled mining rigs. It belongs to everybody, to anyone willing to read a short instruction sheet and press 2 buttons. And we're ending with my favorite of all, the lie that real diversification means zero Bitcoin. Now remember, portfolio theory rewards holdings that improve the return to risk ratio while moving differently from core assets. 10-year data shows Bitcoin's correlation to the S&P 500 sits near 0.15. Gold scores closer to 0.25. Investment grade bonds sit 0.3. On correlation alone, Bitcoin is the stronger diversifier, and quantitative tests literally just confirm the benefit. A 60-40 portfolio held from January 2014 through October 2025 produced a 7.8% compound annual growth rate, which, to be clear, doesn't outrun shadow inflation. It had a Sharpe ratio of 0.63 and a 22% maximum drawdown. If you replaced 5% of equities with Bitcoin and rebalanced quarterly, that lifted the compound annual growth rate to 11.2%, raised the Sharpe ratio to 0.79, and trim the drawdown to 20%. Obviously, scaling matters. Even 1% allocations already move the efficient frontier outward. 5% allocations historically boost risk-adjusted return without dominating total volatility. And Bitcoin also functions as a stress hedge during the liquidity crises of March 2020 and the regional bank turmoil of March 2023. Bitcoin bottomed and then recovered weeks before any equity benchmark. The fixed supply of Bitcoin and the independence from the global credit markets totally created that behavior. And the large allocators have noticed there is a Bitcoin treasury arms race. There are public pension funds in Texas, Wisconsin, Ontario. They're all reporting Bitcoin exposure in annual statements. University endowments at Harvard, Yale, and Stanford are disclosing positions through venture funds and ETFs. And fun fact for you, institutional capital does not adopt an asset merely for speculation. It does so because the data improves the portfolio math. Bitcoin is the apex asset, and everybody is starting to take notice, no matter what your financial advisor tells you. And after the Bitcoin price action like this, most people start asking the right question, not how do I trade Bitcoin, but how do I own it for good? And if you're watching this thinking, oh my gosh, Bitcoin has so much upside because it's 1/10 the value of gold, and you want some exposure, well, guess what? The Swan private team works with high net worth families, individuals, and companies who want to build generational Bitcoin positions safely, securely, and strategically. We help clients understand the macro factors that are driving the Bitcoin transition and how to own real Bitcoin and not paper IOUs. Because the goal isn't to trade the next crash, it's to survive and thrive through all of them. Visit swan.com/no second best to learn more. Subscribe to Swan Bitcoin for more daily Bitcoin insights during the greatest wealth transfer in the history of humanity. Have a terrific day. Do not party too hard. Class dismissed.